Welcome back to Business of Drinks. I'm Erica Ducey.
And I'm Scott Rosenbaum. Today, we are thrilled to have a very special guest. I am very pleased to welcome Matt Rice. Matt, welcome to the show.
Thanks so much for having me. I'm excited about it.
Today's episode is pretty unique. We are going to look back over the last 6 months through the lens of M&A and some of what's going on in the industry. Matt, let's dive in. For listeners who might not be familiar with you or your work, can you give us a little bit about your background and an overview of what you do?
Yeah, of course. Thanks, Scott. So I've been in beverage alcohol for 20 years. I was at Constellation for 19, had a wide variety of different roles. I did business development, investor relations for a few years, spent 5 years in brand management, where I managed spirits brands and wine brands. I then started and ran the corporate venture capital group at Constellation for a number of years before running corporate strategy, insights, analytics, and growth operations. More recently, I work with a variety of emerging brands who are looking to fundraise and be acquired themselves someday. I run a newsletter called The Quench Report, where I just report on happenings in the broader beverage industry. And I work with a variety of investment companies to do deal flow and due diligence and find the next great brands to invest in.
Amazing. Yeah, really comprehensive background. I think you and I met a little bit more than a year ago through some of your initial work with the Quench Report, which we will certainly link to in show notes. We have a slew of questions to get to. But before we dive in, Erica, do you want to kind of give us an overview in your own words of some of what has gone on in this incredibly busy, volatile, and exciting period over the last 6 months?
Absolutely. I mean, I think it really is a pretty interesting moment in the industry. You know, we're seeing a lot of deal volume right now, probably at least 25 to 30 notable bev-alc M&A deals in the first half of 2026. And that's probably an undercount because a lot of the smaller regional craft spirits and beer deals, they're probably not getting broad coverage. So looking across categories, some of the more notable deals, Crimson Wine Group bought Rayburn from Purple Brands, and that's a brand that's about 250,000 cases. So that really gives Crimson a scaled Russian River Valley Chardonnay and Pinot Noir. Jackson Family Wines bought Big Salt, which gives them an Oregon white blend brand when at this time, we're seeing a lot of lighter, fresher whites being one of the few bright spots in wine. Third Leaf bought Cane Wines in Napa, which adds a high-end brand with legacy value to their portfolio. And the Washington wine brand Mercer bought 4 additional Washington brands, which really strengthens their position as a Washington sort of wine platform rather than just a single brand. Also at the high end, saw Saint-Supéry, that's owned by the fashion brand Chanel. They recently bought Rudd Estate and Crossroads, and that asset that was really about the vineyard asset. So there's estate infrastructure there, and it gives really nice luxury positioning. I think one of the most interesting ones that I saw was Kenwood, which is really a valuation reset story. And this one, so back in 2014, Pernod Ricard bought Kenwood from Korbel for close to $100 million. And then in March of this year, Korbel bought it back for a reported $4 million. Right? So over roughly 12 years, the implied transaction value fell by about $96 million. Pernod had tried to premiumize the brand and they cut its volume significantly, which obviously did not pan out. So that's what we're seeing in the wine space. For RTDs, I think the message here that I'm seeing is that RTDs are not a side bet anymore for spirits brands. They are very strategic. Molson Coors bought Atomic Brands, the maker of Monaco cocktails. Sazerac bought Dirty Shirley. Mark Anthony Group agreed to acquire the Finnish Long Drink. The wine group, interestingly, just acquired St. Augustus's Phony Negroni line, which gives it its first foothold in non-alc cocktails. And this was interesting because the wine group had just closed an acquisition last year for several Constellation wine brands. So it's now moving into formats beyond traditional wine. So I think that we see so much of that happening. And then beyond RTDs, we're starting to see Gallo just agreed to acquire Four Roses from Kirin for it says up to $775 million, which gives Gallo a major premium American whiskey platform, roughly 1 million cases globally. And then Sazerac invested in 818 Tequila, and there's several others. So there's M&A happening in spirits beyond the RTDs, but really RTDs is where we're seeing like most of the action happening. I recently read that 9 of the top 20 spirits brands by volume are RTDs. So really, RTDs is where it's at. And then for beer, Firestone Walker and Duvel agreed to acquire Stone Brewing from Sapporo. Tilray agreed to buy certain U.S. assets from BrewDog. Tilray also signed a 5-year deal to brew, market, and sell and distribute Carlsberg, et cetera, et cetera. So, a lot of moving pieces here, but I think, my takeaway is I've heard people in the industry say like, the market is frozen. There's, not capital out there. But I think what we're really seeing is that there's strategic growth opportunities and it's a buyer's market. So there's a lot of opportunities that are starting to shake out. And it really seems like, new routes to market, production assets, premium brands, growing formats, scarce supply, like those sorts of strategic fits seem to be my interpretation of what's happening. So that's it at a 30,000 foot level.
Let's summarize this, Matt. I want to kick things off. Erica gave us so many of the specifics, and obviously there are those deals and many, many more. But giving you a little bit of a challenge, is there a word or a phrase that to you kind of encapsulates what is going on in this first half of 2026 in the beverage business?
Yeah, it's a great question and certainly a challenge. And honestly, at first blush, my answer is something that implies scar tissue. But I think the word I'm going to choose is actually curve. And let me explain what I mean by that. In 2008, during the financial crisis, I ran an executive strategy session, and we needed an analogy to describe what everybody was facing at that time. And the analogy that we picked that I still really like today is speed skating, of all things. If you're familiar with speed skating, you probably watch it, once every 4 years during the Olympics. In the event, there's a curve and there's a straightaway, just to simplify it. And the curve is where all the action is. So the person entering the curve in first place falls, and then they come in last. The person who's in third picks a different angle and cuts in front of the person who's in second. But then once the curve is over, the ranking tends to stay the same. So the person who exits the curve tends to remain in first place. The person who's in second tends to remain in second place. So to me, it feels like we're very much in a curve right now. A lot of consolidation. There's regulatory changes, there's changes with the consumer, there's a lot of uncertainty, there's a lot of M&A. It's very much we find ourselves in a curve, and I find that the companies who are best able to manage this situation are going to end up in a great place once we get to the straightaway, and it's coming. It's a difficult time right now.
Very, very fair. Great word. In the future, when we look back at this time, right, a lot of the individual deals will have likely fallen away as noise, right? They won't likely be as remembered. I'm curious if you've got your crystal ball. Are there any things that stand out to you as some of the top defining events, things that will signal big changes or are different from what is maybe a distressed asset being acquired at a good time or just a purely strictly growth story?
Yeah, 3 events very much come to mind. Well, the first would, of course, have to be RNDC. This is such a disruptive element of the industry and such a signal of where the industry is going. I think when we look back 5 to 10 years, people will certainly point to this as something that not only affected, wine and spirits, but beer and the broader CPG beverage industry as well. Brown-Forman to me is the second. Anytime you have potential for a major M&A or a merger, those things echo for decades. People still talk about the formation of Diageo decades later. It's a once in a generation, and time will tell how exactly it evolves. But just the fact that people are having the conversation and people are considering it really shows how companies are thinking about gaining strategic value and strategic advantage moving forward. And the last is probably broader. Just a word about, I think in general, bev-alc, the M&A was more, 12 to 16 months ago, where you saw a lot of energy brands get acquired. But we're starting to see those acquisition cycle and how well they're performing. And in bev-alc, you're seeing a broad acceleration. And I think it really signals that people are thinking about growth differently.
And now a quick announcement. Are you heading to Bar Convent Brooklyn this year?
If the answer is yes, we have some exciting news for you. We are officially bringing back our second annual Business of Drinks meetup.
That's right. Come join us before the show opens on June 9th at Gumption Coffee.
Come grab a drink, a coffee, hang out with us, swap stories with fellow founders, operators, distributors, and investors. It's basically a Business of Drinks mixer to get the conference started on the right foot.
So mark your calendars. That's Tuesday, June 9th at 10 a.m., an hour before the show opens, at Gumption Coffee, 168 39th Street, right outside the show.
Let us know if you plan on joining us by commenting below. We're looking forward to seeing many of you face-to-face at BCB this year.
And they're realizing optimization will only take you so far. You really need that top line growth to continue to grow and have competitive advantage. And M&A seems to be something that a lot of people are choosing to do at a much faster rate than they have previously.
Yeah, I'll give a couple notes of context there. So just for people who maybe are not on top of the news, for Brown-Forman, that has been talked about really as like kind of a mega deal to watch. So Pernod Ricard reportedly was exploring merger talks, and Sazerac has also been linked to a possible bid. So nothing has closed there, but the fact that Brown-Forman is in this conversation, I think shows how much pressure there is to build scale and leverage at the top of the spirits business. And then let me add also for the distribution, just a recap there for the RNDC situation. Reyes Beverage Group is taking over RNDC operations in 11 markets. That really moves Reyes much further beyond its beer roots into wine and spirits, and kind of, moves us more towards this total beverage distributor model. And then also Martignetti has a letter of intent for RNDC operations in 13 control states. So I think we're starting to see other distributors like Martignetti really kind of understand what type of opportunities are here. And then suppliers also rethinking how they manage their market-to-market execution.
Absolutely. I'm fascinated by this idea that, right, so often we hear these stories and we hear that, someone's failure or upset is, an absolute bad, when relatively speaking, there's typically a counterparty that aims to benefit from some type of correction. Matt, I'm curious if we weigh some of the quantitative, looking at deal flow, looking at numbers with some of the vibe-based sentiment. My question for you is, Silicon Valley Bank has a state of the U.S. wine industry survey that they put out every year. And in interviewing wineries, they found that sentiment among wineries is the lowest that it's been in the last 5 years, since 2021. Is there a reason to think that we've, at this point, hit bottom? We're at the nadir of things, that things will turn around soon? Does this sentiment reflect the reality of the industry today?
I think we're getting close to the bottom. I don't know that we're ready to call the bottom yet, but there's three reasons, I think, for optimism. One being distributor inventories are starting to come down, which is always a good sign. Along with distributor inventory starting to come down, we're starting to see some plateauing or slight improvement in scan data. So consumer takeaway seems to be improving, which is one of the reasons for the reduction in distributor inventories. And third, thinking of wine specifically, I think, there's certainly an element of cyclical trends. And, it feels like wine is really something that's about to be on the upswing. There's a lot of reasons to be excited about wine. If you talk to young people and you ask them, what are they looking for in a beverage alcohol product? It's, in many cases, a lack of carbonation or sort of minimal carbonation. And that's a lot of what wine brings to the table. And so I think there's a marketing opportunity to better inform some of these younger consumers that wine actually does check a lot of boxes and meet a lot of their needs. I mean, you look at the success of things like Beatbox and Buzzballs, they're essentially wine brands. And that's really goes to show you the marketing angle and how if you get the messaging right, you can grow and do really well in this environment.
Yeah, it does seem like we've moved, especially in wine, more from a period of like free fall into stabilization. So I think the thing that I talk to a lot of wineries, and one of the things that people just say like, oh, we're really suffering. The thing to understand, I think, is that the rebound is not going to impact everyone equally. Brands that are successfully marketing to younger consumers are going to have that edge. So it's more, I think, about treating this as a structural reset so that people are thinking like, okay, our pricing, our channels, our experiences, our consumer strategy, are these optimized for current market conditions and like where we think the market is going to go? Okay, so right now we're sharing this graphic that I think it really shows the life cycle that almost every category goes through. And I think it's very indicative of what's happening in drinks right now. But each category is in slightly a different position. You're at the top of the circle there, and it's really showing like a new behavior emerges. You can think of like craft beer, hard seltzer, non-alc. And the next phase then comes growth. You've got more consumers, more distribution, more capital. Then if the category continues to be exciting enough, you get proliferation and overcrowding. But that leads to too many brands, too many SKUs, too many companies chasing what is looking essentially like the same opportunity. So, categories at that point, they can look like they're still growing, but the underlying economics can be getting weaker. So I think that's unfortunately where we see a lot of beverage alcohol today. So wine is maybe stabilizing and in this sort of contraction and shakeout phase, whereas craft beer, I think, has already moved through maturity into the consolidation phase. Spirits is dealing with slowing growth after a long premiumization cycle. And RTDs, as we know, they're still growing. But even there, you can see major players buying brands and trying to professionalize the space before it gets too crowded. So, in looking at a graphic like this, we're not just in one consistent cycle across all of beverage alcohol, different categories at different stages. But the broader business seems to me, and Matt, I'm curious your take on this, it seems like we're moving definitely from this expansion phase into discipline where there are fewer growth stories. There's more pressure on brands to either scale quickly or get out of the market, and more advantage for the companies that are able to rein in their focus and gain really that route to market strength and harness consumer demand. So what are your thoughts there?
Thanks, Erica. It's a great question. And, I think you're completely right that people are looking for efficiency. They're looking at synergies. A few examples come to mind. Tito's acquisition of Lalo 6 months ago, I think, is a great example of this. For a long time, people looked at Tito's and wondered, when is Tito's going to get acquired? And they flipped the switch and now they're an acquirer and they're acquiring a small brand. And 5 or 10 years ago, Lalo probably would have stayed independent for a long time and went for a much bigger exit. And, by joining forces with Tito's, there's a lot of efficiencies. There's a lot of synergies. And I think that's really a perfect example of how companies are operating in this environment and realizing the benefits of that portfolio approach. the relationships with the distributors, the relationships with the retailers, and you can have a plugin. And large companies have done plugins for a long time. All the big suppliers have, but this is one of the first times I can recall of a single brand really making that pivot. Looking to broader beverages, Alani's acquisition by Celsius is another example where more and more companies, more boards, more leadership teams are realizing that, it's not just about growth. Growth is important, but synergies, SG&A synergies, top line synergies are really important and are going to be more important.
Well, let's look at a graphic that you shared and we're sharing here on the screen that's called Better Hurry If You Want a Dance Partner. So in this market, we know that the big guys are desperate for growth. And in a recent Quench report, you pointed out that so many top independent RTD brands have been acquired in the last 6 to 9 months. So there's not many left for larger players to choose from. So would you say, are the largest and fastest growing brands being snapped up more quickly right now?
The analysis that I did had a somewhat arbitrary bar. It was brands doing about $1 million in consumer takeaway and growing 20%. But if you go back in time 5 or 6 months ago, there were 5 of these brands. If you're a big supplier looking for a growth vehicle, you could be a little patient. There could be some disagreements in the leadership team of, oh, do we want this one? Do we want this one? Which one's going to best fit within our synergies and capabilities? But as more and more companies look for these growth levers, they're going very quickly. And I don't recall a time where you had 5 options and then you blink 6 months later and you're down to 2. And there's probably in the teens of companies that could use the 2. And so, yeah, I think the dance partners are going quickly. And I think people are realizing that you have to move fast or you're not going to have any options left.
I think what that makes me most interested in is this notion that, those acquisitions can potentially act as a signal, especially down the chain when it comes to investors. And with some of these independent brands at scale being scooped up, do you believe that this has kind of opened up that avenue of angel investment? Is capital starting to flow to some of these earlier stage new to world concepts like it was 4, 5, 6 years ago before it kind of dried up more recently?
100%. I see more and more angel investing happening in new to world and frankly, some closer in opportunities. And I think it really matters, even when you think about something like angel investing, there's different strategies and there's different comforts with risk. And so, there's going to be a portion of angel investors who are looking for the 100x opportunity. So who are looking for the emerging categories that, isn't established yet. It may be a category in 5, 7, 9 years, but, nobody would even consider it a category today. And then there's other ones that are a little bit more risk averse who may want to go with a tried and true founder and, go after a category that's very hot and trendy right now and try to sort of leverage that growth. To use that Lalo Tito's example, Lalo is a pretty new brand. And I think the fact that they had an acquisition within 5 years of formation is very attractive to angel investors. And so that I've heard from quite a few people that they're leveraging that, case study in terms of a willingness to invest more in angel investing in beverage alcohol.
Interesting. There was something I noticed in your research that I wanted to know more about, which was you pointed out that independent brands like the Surfsides, Carbless, Beatbox, that those have really outpaced those bigger brands from suppliers. So these new to world brands, the Beatboxes and so forth, that they are outpacing the White Claws and the High Noons. Why is it that global incumbents with billions in resources are still struggling to replicate really that startup conviction with their own brands, their own fresh brands?
Yeah, it's a great question. And the phrase that comes to mind is, independents burn the boats. So they go on a journey, they land in a new country, and retreat is not an option. So they burn their boats, and the only option is moving forward. And I work with a lot of these emerging entrepreneurs, and they have everything in these brands. It's all their time, all their attention, all their heart and their sweat. They take second mortgages. They have family involved. Failure is not an option. Anytime you create a brand, you're going to be faced with barriers, and they'll run through those barriers time and time again. Even with all the advantages of a large incumbent, there's always a plan B. If depletions don't quite get to where you want, velocities aren't quite as strong, you can allocate capital to another brand and continue to make plan. So to me, that's the fundamental difference. It's that, that passion, that dedication, that persistence to really ensure that, that new brand is going to work, which separates the two.
I mean, it really does sound like conviction, grit and conviction. Failure is not an option. That does seem to be the prevailing sentiment to a lot of founders that I talk with. And that sounds like it's a pretty powerful force.
100%.
Matt, your research on new to world brands shows that these types of brands control nearly 90% of the malt seltzer category. And I'm curious, now, is there any category left in 2026 where coming out with a line extension is actually superior, like the superior strategy, more flavors? Or should legacy brands stop trying with the line extension thing? Should they stretch their equity into new brands versus kind of expanding outward with pre-existing ones?
I think you're right when you mention flavors. That's the area where I think line extensions can do really well. So if you have a flavored whiskey, that's doing really well, and you want to extend into grapefruit or caramel or vanilla, like those things can work really well. The consumer's accepting, that your brand's offering flavors, and it's just a little bit of a different flavor that you're offering that's maybe more attuned to, consumer tastes at that point in time. So those continue to do really, really well. But otherwise, it's really tough to extend if it's beyond flavor, if it's a different category or even subcategory. There's something to be said in the consumer's mind about products that are born. So it was born a seltzer. It feels like it was curated specifically for the category. It was curated specifically for the taste profile and the consumer, versus a mega brand that's extending can sometimes feel opportunistic. A consumer may say, oh, they cut corners, or they're sort of rushing into it. It wasn't made specifically for this particular category. And I think it matters, and it comes through, and it comes through in the consumer response. Categories evolve a little differently. Malt seltzers now, the new to world is about 90% of the category. And there was definitely a dip where it started at 80, it went down to 60s, and then it went back up. But you see that pretty consistently over time, that those brands that are born into a category over time tend to do better.
Well, let's talk a little bit about distribution. We touched on the Reyes RNDC situation, Martignetti taking over some of RNDC's operations, Columbia Distributing, which my brother works there, so shout out to Sean Ducey. So they have a letter of intent to acquire RNDC's Oregon and Washington markets. So that is a beer distributor going into wine and spirits. Now let's talk about the reverse. Southern Glazer agreed to buy Eagle Rock's Distributing's Colorado operations, which is the opportunity to distribute Anheuser-Busch's full portfolio in Colorado. And then we also saw Southern Glazer acquire Claire Rose in Long Island, which is another Anheuser-Busch aligned distributor. So that strengthens Southern Glazers in a key New York market. And then I think broadly, it's like reinforcing the idea that beer, wine, and spirits distribution silos really are breaking down. So I think that's one point. One question that I have aligned with that is that we know that there are fewer wine distributors, fewer bev-alc distributors than there were in 1995. It's just continued down this consolidation funnel. So where do we go from here? Are we at some tipping point?
It certainly feels like we're getting close to a tipping point. And, I think a lot of emerging brands are finding it harder than ever before to get attention from one of the big, sort of distributors. And so I think it's creating a lot of opportunity. And Certainly a lot of brands are starting to look at things like self-distribution where that's allowed. There's also, I think, much greater realization that the hand selling is really the job of the brand. So I feel like for a long time, there's been this slow realization over time that the brand really needs to be owning this. And if you're a brand owner, you really got to roll up your sleeves and do that hard work of that hand selling. And I think these situations just really reinforce and help cement that how we're going to operate moving forward, it's just got to be different than how we have previously.
That actually reminds me of some news I recently just read about, which is a craft supplier, Baltimore Spirits Company, is actually withdrawing from distribution altogether. They are only going to be selling out of their distillery, out of their tasting room. They've kind of retrenched after being in multiple markets for the better part of a decade. So there absolutely are changes taking place that are, as of now, we don't know how that'll turn out, but particularly exciting to see. We're going to share this graphic here. Matt, you have pointed out what has at least been a gut feeling of mine, that so much of how a brand can perform is based on kind of distributor bandwidth, if you can call it that. The idea that brands need to be a top priority for their distributor within the portfolio. You've done some of the number crunching and pointed out that brands can perform 100 to 200 basis points better when they are a top priority for their distributor. I'm curious, putting this idea into action for, let's say, a mid-tier wine brand that might be living under Raya's roof. Are there any levers that they can pull to stay important while they're competing with the likes of Coca-Cola and Miller Coors for sales reps' attention?
There's a few things that I've seen work really well. First is make it as easy as possible. So make sure that you have all the tools, you have all the POS, you have all the programs in place to make it as easy as possible for that sales rep. I think the second is a realization of those corporate priorities. So you mentioned Reyes, and if you're a small emerging brand, what is the strategic direction that that Reyes is going to direct towards that distributor, and how does your brand align to it? I wouldn't just assume that the local leadership team is going to understand how your brand is aligned. So you should really be bringing that forward. And then I think third is just being really buttoned up. Know the market really well. Know your depletions, know your pods, have your target accounts. Do as much as you possibly can to make it as easy as possible for your distributor partner. But, the last point is, rolling up your sleeves and doing the work with them. So, I found with more priorities, the brands that are making visits into the market and doing ride withs and really working with the distributors do so much better than the brands that just sort of demand more attention, without that active partnership and participation.
I love that. And I return continually to a quote from a former guest, Danny Stepper, who said, you can be small or you can be difficult, but you can't be both, right? If you're small, you have to be easy to work with. If you're big, you've got a little bit more leverage. Yeah, definitely reminded of that.
Well, I'm curious, is there a point of no return for brands where they're just simply too small to be seen by a national distributor?
I think there is. I don't know that there's like a magic number that has to be 100 cases a month. I've heard some people sort of reference that. I think it really matters situation by situation, distributor by distributor, state by state, but 100%. For the reality of that distributor, you have to be material.
And now, a word from our sponsor.
And today, that sponsor is Business of Drinks. If you're building a drinks brand right now, you already know how hard it is to tell what actually matters versus what's just noise.
We see this all the time. Brands have to move fast, but they're often making these rush decisions without enough structure, data, or outside perspective.
That's why we built Business of Drinks Advisory Services, to help founders and leadership teams make smarter calls around growth, distribution, brand positioning, and fundraising.
This is focused, tailored, hands-on advice from the people who've actually built brands, worked with distributors, and helped the best up-and-coming drinks companies scale.
If you want to learn more, reach out. We're at info@businessofdrinks.com. And now, back to the show.
And so I think you really need to ask yourself, given everything that's going on with the distributor, with the people that are going to be assigned to your brand, are you going to be material and are you going to move the needle? And that bar is probably higher than it was a few years ago. And I think, you have to have some hard decisions, hard discussions, and just sort of realize you really want to be somewhere where you're important and you're material and you move the needle.
Getting into the categories, the broad kind of macro categories, wine, beer, spirits, RTD, functional, non-alc. Where today do you see the opportunities? I'm curious, when speaking with others and thinking about it yourself, do you lean into what's growing now where we have that backward-looking data? Or is it kind of fruitless to try to predict where the puck is hit, so to speak, or where the ball is headed when it comes to appealing to maybe a future acquirer or investor?
I love this question, and there's so much opportunity right now across different categories. But I think specifically about where the opportunity is really matters a lot on who's asking. So, when you look at a company like Boston Beer, they came out with Sun Cruiser recently, which has done tremendously well. And, for a company like Boston Beer to put time, effort, and energy behind a new to world launch, it's got to be something that is growing, and the last 52 weeks growth looks really strong. And so that can be a little bit backward looking. But a lot of the brands that I work with are on that 5 to 7 to 9 year trajectory. And so the fact if something is growing right now is really irrelevant. It's really an understanding of the big macro consumer trends and a belief about how this category might evolve moving forward. Some of the best ideas that are getting the most investor attention are actually in categories where it's currently in decline, because there's a belief that, this is cyclical. And in 9 years, when we're ready to have an exit, this is going to be the high growth vehicle. So yeah, I think it depends a little bit about your strategic priorities, but in the vast majority of instances, if you're looking 5 to 7 to 9 years out, you're not looking so much at what the last 52 weeks have done.
We've seen a lot of data that wine has had a challenging time recruiting younger drinkers. And, wine brands, they're built on terroir, but high growth brands, they're built on disruption. So what are the strategies that the wine category can use to start attracting younger audiences who are currently flocking to non-alc malt seltzer RTDs?
It's a great question. And I did an analysis on this a few weeks ago that I think is particularly relevant. One of the first things that wine brands can do is actually hire differently. So one thing that I found in really deeply researching LinkedIn and careers of people in beverage alcohol is wine marketing leaders tend to spend their entire career in wine. And there's nothing inherently wrong about that. But if you're in the same category for your entire career, there tends to be the idea of inertia. So you're learning from, your manager and their manager and their manager, and you tend to do things the same way and use the same tactics and strategies. So if we look at beer, spirits, and energy, they've probably hired outside the category to a much greater degree, and the data backs it up. And so that would be the first thing that came to mind. If you really want to talk to that different consumer, hire differently. Can you hire from companies that are using drastically different strategies and tactics? I talk to quite a few founders and CEO regularly, and they very often are on the lookout for, talent from some of these emerging brands. And it frankly doesn't come up as much with the wine leaders that I talk to. So I think, that's probably step one. Let's get some different perspectives, some different ways of speaking to the younger consumer in the building. And then once we do that, we can formulate some messages and some ways of building that brand equity and awareness.
Matt, I'd love to get your perspective on this notion that some of these fastest growing wine brands, be it Beatbox or XXL, are different from your traditional, right, historic legacy wine brands. And I guess what I'd love to know is, do you have a belief one way or another? Is wine being innovated out of social occasion? Or is this kind of a pricing, packaging, flavor issue? Why is traditional wine suffering while these newer to world brands are enjoying the success?
Yeah, it's a really good question. I think it's a little bit of and though, not or. So I think in terms of marketing, you're 100% right that, the marketing is different, the messaging is different. People in the industry are well aware, but, your average consumer probably doesn't even know that beatbox is wine. And so that just goes to show you it's the same category, but if you think drastically different about this proposition than that, it's because of the marketing that's leading you to believe one or the other. So I think that certainly resonates, and there's something to be said about that. The price point is certainly valid though. Josh is the number one table wine brand in scale and in scan channels. And it's about the same price as a 4-pack of Beatbox. A 4-pack of Beatbox is going to be about triple the volume as that 750 of Josh. And so I think that's certainly playing, a role as well. I think the consumer, sees that table wine continues to go up and is maybe a little bit outside of their price range. And so I think the category needs to, sort of take a hard look at that. Given sort of the financial realities, the inflation realities that consumers are under right now, and figure out a way to sort of deliver that value in a way that consumers are looking.
So I want to dig into the table wine question a little bit more. So for a bottle of Chardonnay, would you say its biggest threat is another bottle of wine, or is it the 12-ounce canned cocktail in the refrigerator case across the aisle?
In my experience, it's 100% the canned cocktail. I interview and talk to a lot of, LDA consumer as part of my work. And, if I show a particular Chardonnay brand and, say, what is your opinion on this? What would you purchase this? What else would you purchase? It's almost never another Chardonnay, that people are kind of choosing. Oh, no, I'm not a wine drinker. Or no, I like my Surfsides or my White Claws. It's certainly the more convenient pack formats, the more flavorful products, and at least in their opinion, that people are gravitating toward.
To that end, I'm just curious. We hear a lot about younger drinkers not necessarily being as tied to a particular brand or being as brand loyal. I mean, do you find that to be true in what you come across in research?
100%. I think if you talk to younger consumers and really dive deep into how they discover brands, a lot of it's through influencers, a lot of it's through social and vehicles like TikTok, and they're very comfortable with brands that have existed for a week or two, and they're standing in line at Target to purchase them. And this is across all CPG. This isn't just sort of a beverage or beverage alcohol, but I think there's that realization that great new brands are always being created, and there's this incredible willingness to be promiscuous and try the newest, hottest thing, which is probably not the case as if you looked over the last couple of decades where people tended to be a little bit more, trusting of the bigger brands, thinking, oh, there's economies of scale. They're going to be driving value. It's a very different environment.
Well, let's put the rubber to the road on this. So let's say that you are an angel investor today with $1 million to deploy. Are you putting this into a Wine 2.0 project aimed at Gen Z? Or are you doubling down on a new to world spirits brand?
I love this question, and I am putting all 1 million against Wine 2.0, which may be a little surprising. You look at the industry right now, wine's a little bit in decline. Hot areas are THC beverages and RTD spirits. But to me, everything is cyclical. And if I'm an angel investor, I don't want to be right today. I want to be right in 9 years. And I believe that wine's time is coming again, and young people will rediscover wine and all that it can be and all that it is. And so I want to be where the puck is going. So all $1 million is going towards Wine 2.0 for sure.
That is heartening. I'm sure to many of our listeners as well. I'm curious, you are so incredibly well informed. I look forward to your newsletter every week. I'm curious where you look. Who is one person in the data and insight space and drinks that you admire, you look to, or you believe looks at things maybe differently but correctly? Where do you turn?
One of my favorite people to read is John Moramarco, BW166. We crossed paths at Constellation for a few years, and I've always highly respected John and everything that he does. Everybody should visit his page and join his podcasts and read his reports. What's incredible about John is he's a very independent thinker. So, you could have 99 people who all have a, particular point of view of, this is the reality, this is what's happening in the category. And John will come back and with extreme confidence say, all 99 of these people are wrong. And here's why. And then he'll go into, 38 different data sources that, sort of confirm why he believes what he believes, and an incredible level of diligence to really do the hard work to make sure what he's saying is validated by the data. So I join every time John has one of his podcasts. He's a great person to follow.
Love that. Well, we'll link to John in the show notes. And tell us, where can our listeners find you?
A few ways they can connect with me. The first is via LinkedIn. Happy to make a connection with any of your listeners. And I do post some, exclusive content on LinkedIn. So that's a great place to, keep informed with, some of the data and analytics that I provide. But otherwise, you can visit thirstyinsights.com, and there's a link to the Quench Report. It's a free newsletter that I come out with weekly with a wide range of analytics and insights into the beverage alcohol and broader beverage industry.
Matt, thank you so much again for joining us today. It's been an absolute pleasure to have you on the podcast. And we look forward to keeping in touch.
This has been great. Thanks so much for having me. First time, long time, been a fan of the show for a really long time. And so super excited to be able to call in and chat with you guys.
Thanks for joining us on Business of Drinks. Subscribe on YouTube at Business of Drinks Podcast, follow us on Spotify, or listen in on Apple or wherever you get your podcasts. Please tap the notification button so you'll be the first to know when a new episode drops.
And help us spread the word. Click those star ratings, give us a review, and share episodes or clips on your socials. It really helps us reach new listeners.
Finally, if there's something that you'd like us to cover on the podcast, tell us. We're at podcast@businessofdrinks.com, or reach out via Instagram or LinkedIn.
We love hearing from you, and we respond to each and every message. Thanks, and see you next time.